What's up, guys? Welcome back to the Bumpy Road to $10 million. This video is not financial advice. You should always do your own research before investing. So, the original plan for today was to go through my personal experience of investing in the Bumpy Road strategy year by year and discuss important lessons learned along the way. Basically, telling you about the mistakes I made so that you can avoid them. However, there are 5 days left now until the new year, and if you plan on following this strategy step by step, then you will start investing in just 4 days on December 31st, 2025. Since our strategy aims to generate almost 3 times the return of the stock market, one of the key questions that is likely on your mind is how is the stock market going to perform moving forward? That's an excellent question, but unfortunately, no one knows exactly, or in my opinion, even vaguely, what's going to happen in the stock market next year or even in the next couple of years. Just have a look at this table. At the beginning of 2025, the median year-end S&P 500 target based on estimates from 16 major Wall Street firms was 6,600. Just over 3 months later, on April 15, the same target was about 10% lower at 5,950, with some firms revising their targets lower by almost 20%. And not surprisingly, year-end targets were revised up again just a few months later when the stock market started performing well. So if all of these quote-unquote experts can change their one-year forecast for the S&P 500 by so much in just a few months, how can us simpletons possibly predict what's going to happen? Well, my view is analyzing historical returns of the stock market can give us a good sense of what to expect moving forward over the long term. In the short term, no one knows what's going to happen, including people who are well paid to make these predictions for a living. Because if they could predict where the stock market is going to go, they would stop forecasting and open a hedge fund instead. So for today's episode, given the new year is just around the corner, I thought we'd do something more relevant than the original plan. Today, we'll go into detail about what is probably the most important of our simplifying assumptions, the projected annual return for the S&P 500. And before moving on, if you found these videos helpful, please hit like and subscribe below. It will help spread the word. Now, if you remember all the way back to episode 1, we started with our 5 simplifying assumptions and what you need to believe to invest in this strategy. Today, we'll discuss assumption 2. Assumption 2 is that the S&P 500 is assumed to return 9.5% annually on average moving forward. Given our portfolio is primarily comprised of UPRO and SPXL, which generate 3 times the S&P 500 return on a daily basis, this is a critical assumption. So let's discuss it in more detail. Now, to get a sense of how the stock market will perform in the future, it's a good idea to start by analyzing the past. We'll start by looking at S&P 500 historical returns, and to minimize any bias, we will look at the historical returns over a number of different time periods. 5 years, 10 years, 20 years, 50 years, and even 100 years. And to be clear, these returns are as of November 30th, 2025. So for the last 5 years, as you can see here, the annual S&P 500 returns with dividends reinvested have been a stellar 16%. Remember, these are annual returns, so 16% a year over 5 years implies a total return of over 100%. Now, for the last 10 years, the annual S&P 500 return has still been excellent at 14.5%. So it's clearly been a great decade for investing in the stock market. If we go further back, for the last 20 years, the annual return has actually been a bit lower at 11%. An important thing to note is this 20-year time period includes the global financial crisis right at the beginning of this 20-year period, where the stock market declined by almost 60% from 2007 through March 2009. But despite this massive decline, the annual 20-year return was still a solid 11%. Taking a step back, remember, our assumption is that the S&P 500 will increase by 9.5% per year moving forward, and the historical 5-year, 10-year, and even 20-year returns we just discussed have been well above this level. This gives me a lot of comfort that 9.5% is a relatively conservative assumption. Now, for completeness, let's go all the way back and look at the 50 and 100-year annual returns. The 50-year annual return, as you can see here, is around 12%. And here you can see even the 100-year annual return is still above our assumption at 10.5%. This time period includes all kinds of wars, crises, pandemics, and so on. Now, obviously, just because something has happened before, even over a 100-year period, does not mean it will keep happening. For example, there could be a World War III, in which case we'd have bigger problems than stock market returns. But in my view, historical returns over such a long time period are a pretty good indicator of what we can reasonably expect moving forward. If I had to bet on what the annual return over the next 20 years would be, based on history and the charts we've just seen, I would bet it would be over 10%. But to be conservative, for this strategy, we are assuming a 9.5% return moving forward rather than something higher. Now, for those who have limited experience with the stock market, the chances of earning a smooth 9.5 or 10% per year every year is close to zero. The journey will be a lot more volatile, as we have said from day one. For example, we just discussed the 5-year annual return was a solid 16%. However, this includes 2021, where the returns were close to 30%, and also 2022, where the returns were around negative 20%, as you can see here towards the top right of this chart. So our journey is going to be anything but smooth, and the variance year over year can be very high, just like our favorite green line here. That's why it's crucial to have a long-term view. With the stock market currently at around all-time highs, there is a reasonable chance that 2026 or 2027 can be just as bad, if not worse than 2022, despite what any of the so-called experts tell us. We just don't know. But the beauty of having a long-term view is it doesn't really matter. We are investing for the long term, and these large drops early on will actually help us buy UPRO and SPXL at lower prices, while our put options will help us sleep at night knowing our portfolio is protected in the event that UPRO and SPXL go to zero. You definitely need a thick skin and a lot of patience to invest in this strategy. Whenever there's a market downturn or crash, come back to the 100-year S&P 500 chart to get perspective. There is a great chance that the crashes we will inevitably experience are just minor blips and that there is a strong recovery just around the corner. Time and patience are our best friends, and in this strategy, like everything in life, good things will come to those who wait. So guys, that's it for our most important simplifying assumption. Hopefully today's video has helped convince you that our assumption of the S&P 500 generating 9.5% per year on average moving forward is a conservative one. If you are just starting to invest in this strategy over the next couple of days, I wish you nothing but the best. Just remember, it's definitely going to be a bumpy road. If you have any questions, please drop them in the comments and I will do my best to answer. I hope today's video was interesting. Please don't forget to like and subscribe below. We'll be back next week to discuss our last simplifying assumption, which we will call no catastrophe. As always, thank you for your time, and I look forward to seeing you next week.